analyst at Native Agriculture Financial Services. NAFS is also what we're known as. It's a little bit shorter. We are a lending institution that is focusing on using some of the farm credit services opportunities through an OFI system to get that capital deployed to our local communities. Tommy is going to be discussing today financial risk in agriculture, and I'm going to let her get to introducing herself and get going.
Hello everyone, can you hear me okay? Ty, give me a thumbs up. Perfect. Hello everybody. My name is Tommy Peterson. I am the Chief Lending Officer for Native Agriculture Financial Services. And today I'm going to talk about financial risk. I think this is wrapping up our risk series of webinars and we're ending on a good one, my favorite, financial risk. Like Ty said, our mission is to be a reliable, trusted partner in providing capital to support agriculture production, rural business development, rural infrastructure for Native farmers, ranchers, and agriculture communities. One of the first topics I'm going to cover in financial risk is asset management and control. We will go over the risks associated with operational assets and go through ways to mitigate these risks to protect the equity in your farm or ranch. The three different categories are financing, leasing and renting, and overall ownership. So financial risks. These are risks associated with utilizing various financing to fund your operation. Within this section, we will break down the risks into collateral, credit, and then explain a few sources of credit available. So we talk about ag collateral or agriculture collateral. Along with receiving financing in its various forms, a security interest in an operation's assets are required in many situations. Producers need to be mindful of what is being taken as collateral and how long there will be a secured interest. So this comes into play when you are getting a loan. It doesn't matter what kind of financial institution, but they take what's called agriculture collateral, sometimes as security. What is a security interest? A security interest is an enforceable legal claim, lien on collateral that has been pledged, usually to obtain a loan. The borrower provides the lender with a security interest in certain assets, which gives the lender the right to repossess all or part of the property if the borrower stops making loan payments. The lender can then sell the repossessed collateral to pay off the loan. Most of you know when you get a car loan or a home loan, your home is the collateral or your vehicle is the collateral for that loan. When you get an ag loan, whether that be for operating or to buy livestock and things like that, the bank or your financial institution will take all of your ag collateral as a security interest to secure that loan. The risks in this include selling an asset that an institution has secured interest on without their knowledge and approval may not only be bothersome, but could also have legal implications. Issues with getting other or future credit due to operational assets being collateralized already. That meaning you don't know that most of your assets have been taken as collateral for an operating loan and you go to get another loan to purchase a tractor or some kind of asset, and the creditor says all of your assets have already been collateralized by an existing loan you have. The ways to mitigate these risks is when engaging in financing activity, whether that's credit, farm programs, or etc., it is important to read through your security agreement in full. Knowing what kind of agreement is being signed, the details of what is all being taken as collateral, and the length of the agreement. So anytime collateral is being taken, there will be a security agreement within the loan package and you will sign it. And in that agreement will list out what is being taken as collateral and for the length of time that it will be taken as collateral. It's very important to read through that agreement in full. It may be burdensome, it may be very long and have lengthy language, but it's very important to read through that agreement to fully understand what is being taken as collateral. The next I'm going to talk about is agriculture credit. Agriculture credit is a specialty credit advanced to farmers and ranchers, agriculture producers, and others to finance ag transactions. These transactions include loans for equipment, land, and operating, etc. The risks in this include the possibility of loss due to a borrower's defaulting on a loan or not meeting the contractual obligations. Not managing credit responsibly causes poor credit worthiness, which can lead to high interest rates or unable to obtain credit in the future. Ways to mitigate this risk is managing your debt to asset ratio, which I know is very complicated, but really you need to know how much debt your operation can take on at one time. Management of a cash flow. At the end of the day, how profitable your operation dictates whether your debt obligations can be met. So simply, you just need to understand how much debt can you take on concerning how much money you're bringing in. You have to manage these things in order to mitigate that risk of taking on credit. One of the other big things is unsecured credit. An unsecured credit is a loan that doesn't require or take any type of collateral. Instead of relying on a borrower's assets as security, lenders will approve unsecured loans based on a borrower's credit worthiness. Examples of unsecured loans include personal loans, student loans, and credit cards. There are risks involved with this. There's a negative impact on debt to asset ratio, meaning you have high debt without the assets to show on the other side of your balance sheet, and your percentage of equity of an operation. Unsecured creditors may decide to initiate legal action to collect on the debt as well. So you could have legal action against you even if it's unsecured. To mitigate these risks, you have to manage your unsecured credit wisely. If you have a credit card, manage that. Even you don't have someone looking at your balance sheet for you, telling you how much debt application you can take on. You have to manage that yourself to see if you're able to take on credit card debt or student loan debt or personal loans that are unsecured. This slide, I'm going to go over a few resources that are available to you, especially for agriculture credit. First, of course, is the Farm Agency FSA farm loan programs. They have a loan assistance tool. If you go to their website, they can break down all the different loan programs they have and how to apply through them and who is eligible. There's also the Farm Credit System. Farm Credit also has on their website a lender tool. It can find the lender that is available in your area. There's also Community Development Financial Institutions, or the CDFIs. There's a native CDFI network. If you go to that website, it can list all the CDFIs and where, if they're located near you, if they're servicing the territory you're in. The last, of course, would be local banks and credit unions. There's also, banks or credit unions in your area that are available to you. Some of them do ag credit, some do not. That's why there's other options for agriculture credit through the USDA Farm Service Agency and, of course, through the Farm Credit System. CDFIs are there to serve the rural, small communities that are in need of financing the most. So I do recommend them in certain situations where individuals have a hard time obtaining credit elsewhere. Next, I'm going to go into leasing or renting versus owning your assets, whether that be buildings, land, livestock, or equipment. Buildings. Renting farm buildings is similar to the common rental practices of other business infrastructure. The financial risks come from the issue that when many farm buildings, there isn't an established market to base rental rates from. For farm buildings like grain bins, commercial grain storage facilities provide a competitive market rental rate that can be used by a farmer to assist in pricing rental rate of private owned grain bins. It's just not every day do people rent farm buildings, so that's kind of hard to judge whether or not you're getting a fair rate on your rent. As always, buildings are subject to risk of damage from various factors like weather. Your risk mitigation for this would be whether you're the building owner or looking to rent, determining the proper rental rate can be difficult. Making use of existing templates and worksheets can help calculate the correct rate. Some of these examples include if you go to um, Purdue, they have some figuring rental rates for existing farm buildings. If you go to some different extension sites, they do have farm building lease examples. These are all very older documents, but they have good templates and calculations to help you calculate the right rental rate for farm buildings. Moving to equipment. So the risks associated with leasing equipment, the total cost. In the long run, lease payments may be more expensive than the cost of purchasing equipment in certain situations. You have contract terms. Contract terms may not align with your operational needs. Maintenance. Lease agreements may require you to take on responsibility for maintenance and repairs. The risks associated with owning equipment. You have your maintenance cost. Not maintaining equipment can lead to costly repairs in the long run. You have non-productive. A machine may break down and you have no way of finishing your project or finishing your farming, planting, and whatnot. And you also have depreciation. A machine can depreciate quickly, which could affect your resale price, your balance sheet, and things like that. Moving on to land. Some of the cons of owning land. Principal and interest payments associated with purchasing land can create cash flow problems and limit the opportunity to make other purchases. Restricting the amount of working capital can affect the potential profitability of a beginning farmer with limited capital. Just saying that land's very, very expensive, and those payments can be difficult to cash flow. Land has a lower return when compared to other uses of capital like machinery, livestock, and annual operating inputs. Attempting to own all land used on the farm could restrict the farm to a size that is insufficient and unable to employ new technologies effectively. Just saying that sometimes a farm could be too big. It's difficult to keep up if you own a lot of land, but you don't have the equipment or the livestock to run on all of it. Some of the cons of leasing land. Most leases are short-term. There is uncertainty about whether all or a portion of leased land could be lost or fairly short notice, and how this could affect the future business. Landlords are often reluctant to make improvements to land, buildings on leased property. Tenants usually cannot justify making improvements because of the uncertainty regarding the future control. If land is not owned, equity can only be accumulated in the machinery, livestock, or savings, and this could limit the ability for farmer ranchers to borrow money to reinvest in their business in the long run. Leasing land, you don't know if you're going to have it every year. It is risky. It's hard to make plans for the long term. So you kind of have to look at it as a annual or short-term time frame when you're looking at leasing your land every year. There is no advantage to owning or leasing agricultural real estate, but balancing the combination of the two is important to effectively use available labor, machinery, and capital without taking other financial risk on for your business. Risks associated with leasing. Now, this is just farmland. Cash rent leases offer predictable and consistent net returns to landlords, but tenants take on all the risk. Crop share leases provide the opportunity to transfer some risk from the tenant to the landlord. But from a landlord's perspective, in years with high crop yields or crop prices, the net return from a cash rent leasing agreement may be less than that of a crop share leasing arrangement. We're going to move on to livestock. the risk associated with leasing livestock. You have, of course, the animal health. Leasing arrangements could lead to inadequate care of the livestock. There's financial risks, unpredictable cost related to animal maintenance, health expenses, market price violation that can impact profit, legal issues, contract issues, conflict over lease terms, responsibilities, or animal ownership can lead to legal complications. Production risk and management. Different management animal handling techniques between the leaser and the leasee. You may handle livestock differently than the owner of the livestock would. You have biosecurity risks. Moving and mixing livestock can increase the risk of disease spread between animals. You have insurance coverage. Insufficient or inadequate insurance can leave both parties exposed to financial loss from accidents, diseases, or other unexpected events. And you have market risk. Demand for livestock products can change in any given moment that can affect the economic viability of a leasing arrangement. The risks associated with owning livestock. There's health risks. Livestock are susceptible to getting sick. They can affect the overall productivity and lead to a huge financial loss. You have financial risks, costs related to feed, vet care and maintenance costs, or operational risks. Inadequate facilities, inefficient labor, unproductive labor can affect livestock productivity and welfare, and poor management practices. You have environmental risk, you have drought, flood, natural disasters. All of those can impact your livestock. Legal and regulatory risks, compliance with regulatory requirements on animal welfare, EPA, food safety, and violations can lead to fines, legal action, and business shutdowns. And you have insurance risk. Inadequate insurance coverage for livestock losses, property damage, or liability can leave owners financially unable to recover. And you have market risk. Price volatility and consumer demand is very volatile in livestock industry. So you have to be very mindful of the market risks out there. Next, I'm going to go into the overall financial management of an operation. I'll go over how to analyze your financial statement of your operation. This is a big swing from what we just talked about. This is actually more of your risk mitigator. This is actually looking at your financials so you understand them, so you can understand where there's issues, where there's positives, and how to utilize knowing your financials, whether that's to get a loan or whether that's just managing your overall operation, deciding when you want to own or lease things, and stuff of that regard. A financial analysis is the process of assessing your financial statement to determine the health and performance of your business. The different financial statements we'll go through is a balance sheet, an income statement, and a cash flow projection. The first one I'm going to go through is your balance sheet. A balance sheet will include your operations assets, what is owned, what you own. And then the other half of your balance sheet will include your liabilities, what is owed, what debt do you have out there. And of course, it'll show your overall equity at a particular point in time. A balance sheet is what's a snapshot of what your current financial position is. So the considerations you have to look for in a strong balance sheet is if you have a positive net worth. Your net worth is, or some people call it your equity, is your assets, all of your assets totaled up, minus all of your liabilities. When you take that number, that is what it's called your net worth. It's what you own that doesn't have any debt. If that is positive, that means that could be you have a positive balance sheet. You also need to have a good debt to equity ratio. It's just adding on more to your net worth. Is your equity, the net worth you have, stronger than the debt you have out there? That's a ratio that the bank or a lender will look at heavily to see if you have good repayment ability. There's your current ratio. A current ratio is what's happening in the very short term. It is what's happening at the very beginning of your balance sheet which would be like cash and cattle or crops in the ground, stuff that is going to be money liquid within 12 months, against what debt you have due in 12 months. So it's just pretty much saying, if you're a livestock producer, will my calves bring enough to pay the operating line and the payment I have on my cows? It's very short term look at things, but if you have a strong current ratio, that means you have a strong balance sheet. Do you have balanced assets? Overall, it's called a balance sheet because you want it to be balanced. Is your short-term debt match what you have for short-term assets? Does your long-term debt match what you have for long-term assets? Usually long-term is something like land or buildings and infrastructure, something that is going to last a long time. And the debt, is it in the right place? If you look at your balance sheet and you have a lot of debt that is short-term or something that is due within the next few years total, but all your equity is down here in land or buildings, that means that your balance sheet is off balanced. You want a balance sheet to be even. You want your long-term debt down there to match your long-term assets, and you want your short-term debt to match your short-term assets. And overall, you want your assets to be much heavier and much stronger than the debt you have on it. So that's an overall short glimpse of what a strong balance sheet kind of looks like. I didn't put in here what a weak one looks like, but it's everything just backwards. Do you not have a lot of equity? Do you have too much debt compared to your assets? Does your current ratio not look good? Does it look like with the cash you have on hand, you can't make your payments that are due in 12 months? Things like that can show that you have a weak balance sheet and it is difficult to continue operations if that goes on. The next financial statement I'm going to go over is what is your income statement. An income statement shows an operation's revenue and expenses over a period of time, indicating a net profit or net loss in a given period. So simply, that's just what money did you have coming in for the year and what money did you have going out for the year. And it's usually in a 1-year time frame. This is as close to as what you probably do during your tax period, what you tell your tax accountant to do your Schedule F. This is kind of as close as that will be. It's pretty easy to tell if you have an income statement that's positive, meaning that all your income that you got, your calf sales paid for all your expenses and all your debt payments, or let's say all your farming, all the corn and wheat sold, covered all the expenses, and you have money left over. Profitability is a key analysis function when looking at an income statement. Overall, you just want to know, is your business making money and covering all the expenses that you incur over a year? The third financial statement I'll discuss is your cash flow projection. Your cash flow projection is used to predict what future cash will be coming in and what future cash will be going out during a given period. Projection dates usually match your income statements. So it's just saying, you're thinking about what's going to happen at the end of 2025. How are my crop sales going to go, and how are all the expenses going to be for the whole year, so I know what I look like in December of this year. A cash flow projection is only as good as the numbers used, meaning that when you're thinking about income coming in and expenses, you have to be realistic. You have to have realistic estimates will make for a more accurate projection. Your net cash flow. So that's just it's what's netted. So it's your total cash inflow minus your total cash outflow. So all the money coming in minus all the money going out equals what you're going to have for a net cash flow. And then a very important ratio that lenders use is the debt service coverage ratio. It measures an operation's ability to pay its current debt obligations. The debt service coverage ratio is the cash flow available. So it's after you take all your cash inflow and you minus it from your cash outflow, that number divided by your debt service, which is your loan payments. So pretty much all the profit you had, can it cover your loan payments? So it's just showing like how well you're able to make your payments and if that is positive. Because then after, if it's positive, that means you even had profit after all loan payments were made. Cash flow projection is a really great tool to use internally to plan for the future. Projections long term are useful just to kind of plan, but knowing that market volatility really factors in there. We don't know what crop prices or livestock prices will be every year. You want to be conservative and realistic on both the income you're getting and what you may be spending in expenses. You have to be real on what you are actually going to spend. And those numbers, if used correctly, can really help you plan ahead, especially when you're trying to take on debt or get credit. So that help so you can expand your operation and buy future things. One of the last financial management tools, which overall crop insurance has been talked about a lot, but it is a cornerstone to help mitigate risk. It's it protects and impacts not just your yields, but your revenue loss as a farmer and rancher. Every farmer and rancher out there, producer, should try to have crop insurance of some kind if it's available to you in the crops you use. If it's available to you in on a revenue loss availability, I highly recommend getting in touch with crop insurance agents in your area if they're or if they're out of your area, if there's agencies out there that are looking to service your territory you're in, getting a relationship with them can be really, really helpful in the long run. Crop insurance is the cornerstone of risk mitigation when it comes to not only market volatility when the markets change, but of course when it comes to weather, which we know is a huge factor. Some years it's never going to rain and we're in a drought, and some years everything looks great and then you get hailed out. So it's just a cornerstone to have crop insurance in multiple ways you can get it. So that was my final slide on financial risk. Here is our third Wednesday webinar series. We will have a webinar series going through all the way till next summer. We have various partners and experts we're going to bring in to talk about the various aspects. As you noticed, we have crop insurance in there many times. If you want to learn more about that, that is a very important tool for risk mitigation. But also there's some other ones that are very important when you're looking into, land and leasing, the FSA loan program, stuff like that. So feel free to take note of the upcoming webinars